Let's start with the money coming into the fund, first of all. By and large, that's pension fund money. It's coming from most parts of Europe, some from Asia. What makes it very interesting is that the money itself has been allocated either out of the real estate, by and large, real estate allocations of their own funds. Very little of it has come out of the fixed income side. That in itself, I think, is very interesting. We often badge the fund we're working on as being core style risk with core plus returns. And that is based around the idea that you have the equity cushion, which we've all spoken about in different ways, to protect your investment. At the same time, we have a very high level, exactly what you're saying, Richard, about stable income, a very high level of income. We target something like 70-75% of the total return as income. So we very much see this, if you're equating it to a real estate style investment, the high proportion of income out of your total return and the protection on the downside is a core style risk. But the absolute level of return, which we're targeting, is around 8 to 10%, is very much a core plus type return. And that's where we get the expression from. But I think what's actually quite curious is the attitude of most of the investors is they've dabbled with a little bit of mezzanine, they've looked at some senior, and neither have quite made what they wanted in terms of the risk-reward balance. And that's why they've turned to this whole loan style product, which I think has caught the imagination of quite a few investors that we're talking to. If you look at it on the deployment side, because it's all about money in, money out, so we've talked quite a bit about the money in. Who are the people that really want to borrow this? And I think it's quite interesting in itself because a lot of people sort of recoil at the idea of paying the kind of returns we need until what we do is we sit down with them and explain very carefully, well, we're offering you 75%, and you can do it for 7 years non-amortizing, and we're not actually going to be any more expensive than the blended return required by senior plus mezzanine together. And that's our pricing envelope. And I think that is an education process for the market as a whole. And I think for all of the alternative funds, whether it's ours or Paul's or anybody else's, the key issue is having to educate the borrowers why they should come to you if the banks are still offering, in some cases, the fund brief-based money at just a little over 150 basis points. And I think the niche that each party has to play in will determine what has to be offered and what has to be said to the borrowers to get them to understand the individual products.
So in essence, you've got to have a very cogent argument about why exactly they should come to you, and it's really if they're looking for that specific financing niche, really.
Yeah, it's got to be, absolutely. If you're vague, if you're not clear about what you're trying to raise your money for and what you're trying to deploy it for, you're basically sucking fumes all the way, like on an empty petrol tank.